Let's get to our market panel. Ryan Dietrich of Carson Group and Brooke May of Evans May Wealth. Guys, good afternoon. Ryan, stocks were already expensive, and they just surged on a 50 basis point rate cut. So why do you think investors can still buy here?
Yeah, John, thanks for having me back. Happy all-time highs, happy Talk Like a Pirate Day, and it's also my son's 12th birthday, so happy birthday to Gus. But listen, as everyone's talked about on your network a lot, the next 2 weeks are historically pretty weak in terms of kind of seasonality. October is the worst month in an election year, so let's have that kind of out there. But the reality, again, is we're not going into recession. Come on with you all year saying there's no recession. Slowing down, sure. Look at initial claims, right? 4-month lows just today. That's a good real-time indicator for what's really happening with the labor market. We can get into all the weeds of it, but we'll look at another 20% gain this year on the heels of last year's 20% gain. We do think, John, there's more upside once we get through the election. But one thing to think about, and I sent this to you, when the Fed cuts near all-time highs, within 2% of all-time high, like they just did obviously yesterday, found 20 times back to 1980. S&P's higher about 14% on average, higher 20 times, every single time. So listen, who knows, this is 21. We think it very well could be. Now, I'll be clear, we were about 3% away back in 2007 when they cut. So, you can always add an asterisk to it. But the reality is don't fight the Fed. We're still in that camp here.
Okay, now, Brooke, now that the Fed has started cutting, how do you use fixed income in portfolios to balance risk? How much and what kind?
Mm-hmm. Fixed income, it's a broad spectrum. And when we look at our portfolios, we tend to buy quality, and then we'll supplement it with some high yield, but from a fund or from a manager. So right now, we're buying out 3 to 10 years, diversifying into a ladder, and really looking for high coupons, high quality, and just wanting to have that diversified maturity stream.
So, Ryan, worst case, you have a market that's expensive. Best case, fairly valued. We did see this sugar high today from a 50 basis point cut, which is not the type of cut we usually get when we come into a cycle without a crisis. So does this rally have legs now, or are investors due to step back and say, okay, it started here, it's time to sell the news?
Well, we could very well see some sell the news. Again, we talked about the seasonal. Maybe back to John's original question, asked me about valuations. Look and Mike just talked about this, the broadening out, right? And I know small caps sometimes are a dirty word. We still like small caps. They're at 12% for the year. It's not as much as large caps, no. But if you look at history, it's once the Fed starts cutting is when you see that outperformance of small caps. And we mentioned, the market is kind of expensive, but small caps are historically cheap relative to large caps. Mid caps are actually our largest overweight at Carson Group. We like that area also. So SMID in general, we think it's a lot of opportunity because the Fed's now cutting. And one other thing, hey, earnings growth is coming in. If you look at small caps earnings next year, they're like high teens. S&P's not expected to grow that high. We think that could be a little low. So we see a lot of earnings growth and cheap valuations of small and mid caps. So that's a nice part of the market that you know what, I don't want to buy something pricey. That's where investors should look. And we think it still looks good the next, let's say, 6 to 12 months here.
Okay, great. I'll note FedEx earnings are out. We're going through those results. Stocks popping initially here. As we do have that cross the wires. Brooke, it's down. Okay, it's down a lot. It's down 12%. So we're going to get you those results shortly here. In the meantime, Brooke, bottom-up year-end target price for S&P, based on your calculations, 56 to 5,800. We closed here at 57.13. You looking to change that call, or are you putting the money to work elsewhere, like, for example, small caps?
Yeah, we are. We like small caps. I couldn't agree more. That said, there are quite a few tailwinds right now in the market. We're setting the expectation near term, fully expect volatility. It's an election year. We've got debt ceiling negotiations coming up. September, October tend to be the worst performing months of the market. So in the next 6 weeks or so, we think the market will bounce around and the risk is probably to the downside. Going forward from there, though, I think we could see higher levels in the S&P, and I wouldn't be surprised if we revise our price target a little higher. We could raise it to 6,000 for year end. When you've got the amount of cash that we've got sitting on the sidelines and economic data that's coming in pretty favorable, that very well could fuel a leg up in the market.